Hi, I'm Hank Nicholson with SilverPeak Wealth. Trying to balance the risks, make good decisions, while still adhering to a long-term strategy is very difficult in a time like this with great uncertainty. One thing that has made that job a little bit easier for clients of SilverPeak Wealth is having a decent allocation and owning a bit of non-traded REITs. To illustrate this, just look at the year-to-date chart of these three assets. We have the CIM Real Estate Income Fund with almost no price variability, the Dow Jones Industrial Average, and the U.S. bond market. We've been getting a lot of questions about these non-traded REITs with everything going on in the market, so I kind of wanted to address those and address more broadly what's going on with commercial real estate, specifically with the investments that our clients own. First of all, what are the problems right now in real estate? The things that have gotten hit the hardest: assisted living, senior living, anything that's vulnerable to a COVID outbreak. These type of REITs, these type of properties, obviously have gotten hit badly. Hospitality, hotels, people aren't traveling. These are clearly down. Another, retail and malls. Malls are obviously been shut down too, and so all these areas of the real estate market are just getting crushed. Luckily, we own very little of that in the two investments that we have with our clients. Just to take a quick step back, for those of you who aren't familiar, what is a non-traded REIT, and why is this different than other REITs? First of all, I would talk about the two REITs that we own. The CIM Income, formerly Cole Capital, a lot of the clients have owned that for a long, long time, and more recently the Blackstone BREIT. Both of these portfolios are very similar, so I'm going to talk about them and the similarities that they share. First of all, it's a basket of high-quality commercial properties. These are properties in industrial spaces, Amazon warehouses. They're in retail, like Walgreens, Best Buy. They're in office space, major headquarters, and they're also in multifamily or apartment buildings. Both of these pay a dividend of about 5.5%. That's paid out monthly. It's very steady. You can reinvest those dividends if you choose to, or for clients needing income, it is a great income stream. Diversified across industry, region, and tenant. No one tenant makes up more than 5% of the portfolio, and they're diversified across regions and industries just for such events like this, where certain segments of the real estate market get hurt worse than others. Another similarity of these is that the share price that investors both invest in and sell at, and that's held in their account, that share price is determined by third-party appraisers. So it's not the vagaries of the stock market or what a landlord might say a property is worth. These properties are actually appraised by a third party, and that filters into the share price. A lot of transparency. In addition to that, low cost. They charge a management fee for managing these portfolios. There's no transaction fees when they buy or sell properties. So it's a very investor-friendly type package, and there's no cost to buy or sell. And the price you buy and sell at is whatever it is on that day. So that same price is what you buy and sell at, the NAV, the net asset value. So that's a non-traded REIT in general. Now, specifically the two REITs that we're mainly invested in. First of all, Blackstone REIT, BREIT, it's up on the year. I'll just let that sink in for a minute. It's actually up on the year. Their portfolio is approximately 80% in apartments and industrial. So you can't think of a more recession-proof, COVID-proof type real estate portfolio. It's where people live, and it's the industrial, the warehouse space that they need to ship goods. In addition, they have 7% hospitality. That got hurt. And they also have 13% of liquid debt. It's mainly just money that they're waiting to put to work. But those two slices of the portfolio, about 20% of the portfolio is going to get marked down, or has already gotten marked down. But all in all, 80% of the portfolio apartments and industrial, we really like that. And they're having more money coming in than they're having going out, so they're really excited and think they'll be able to put money to work at even better prices. One other thing that I'd say, this is true for both Blackstone and the CIM, no tenants have asked for any kind of rent reductions or any kind of term altercations. So B REIT up on the year, CIM, formerly Cole Capital, also up on the year. Cole, CIM, unlike Blackstone, retail, which could potentially be vulnerable. It's nearly half of their portfolio. They own no malls, no outlets, and almost no multi-tenant retail. The retail that they own is necessity retail. We're talking grocery stores, pharmacy, home improvement. And again, no tenants have expressed any kind of need for rent reduction or rate relief. So that's about half of the portfolio. The other portfolio is 30% office. Two of their big holdings are major Fortune 500 office headquarters. One is Valvoline, the other Republic Waste. Both of those were what you call sale leaseback. So the company develops the property for their headquarters. They sell it to CIM on a leaseback. It's a very nice arrangement. CIM has a great tenant that they know is going to be around. Final 20% of the CIM portfolio is industrial. Again, industrial is probably the best sector right now, given that everything has gone online, and that means lots of warehouses. So in the CIM portfolio, you have 127 different properties, and again, net capital inflows on both of those. In other words, people are moving money in. So we continue to allocate money into these different areas. We think that, given that you're going to earn 5.5% dividend and you own the underlying real estate, we think that investors should expect, returns anywhere from 6 to 9%, and an average return year. And I would say too that both of these funds have incentive structures. The managers at Blackstone and at CIM, they have identical incentive structures, and basically what it says is that they don't get any incentive pay until the investor returns at least 6%. So we know that our investors are going to see a 6% return before any bonuses are paid. Blackstone, they take that a step further. With their bonuses, they actually just bonus out in shares of the fund to their employees with a lockup. So, I like that. The managers of the fund are long-term investors in the fund as well. So that's the update on the non-traded REITs. Please reach out to us if you have questions. Most of our clients, especially our larger clients, already have large positions in both of these funds. But if you want to discuss these, please reach out to us. We're always here to help. Thanks much.